all know that tariffs impacted the direction of the market and, more importantly, changed the sentiment of all of us investors. And just to kind of recap those numbers, on the first quarter, the industrial average, the Dow Jones Industrial Average ended negative 1.39%. The S&P 500 came in at negative 4.6%, and that all-important tech NASDAQ came in at negative 10.4%. Ouch. For those of you who are new, anything below 10% from the indices' most recent high is a market correction. So we are in correction territory on NASDAQ. There are a lot of aggressive stocks, especially in artificial intelligence and software and cybersecurity, that are down much greater than 10%, but that's where the indices came in for the year. So, what can we look forward to in the second quarter? Honestly, it looks like what we say. I wish I was not the bearer of bad news at this point, but because of the policies coming out of the White House and that creating a whole lot of uncertainty, we don't see any changes in the near term. So, what do we as individual investors do? Well, I'll tell you what. We hold the course. We stick to our discipline. All right. So if you're a long term investor, especially in your retirement plans, as we all should be, you buy, you hold, and in times like this, stick to that discipline, meaning keep pumping money into those 401ks and funding those IRAs. And hopefully, you've had good stuff all along the way, meaning your investments are working for you. They fit your risk profile, whether you were 22 and just starting out in life, or you are in your mid 60s looking at, or you are already retired. We will get through this. And as a matter of fact, especially for you young folks, when the market is down like this and sentiment is negative, this is the time where you really want to get in and stretch and take some risk. It will turn around and it will benefit you over the long haul. If you are a shorter term investor, or maybe you're doing both long term and shorter term investing, you're trading stocks, you are investing through options. Guess what? This volatility can work to your advantage, but I'll tell you what, we don't see a bottom anywhere near where we could be in the near future. Meaning, look, anytime we get more information on tariff talk and those retaliatory tariffs are going to be hitting today, March 1st, and then some more come March 4th, we don't know where the bottom is going to lie, but keep your eye out on things you've been watching. Hopefully, you've got good things on your watch list. And again, for you newbies, a watch list are a list of investments that you put together to keep an eye on to make an investment. So usually we look at individual stocks on a watch list, but of course you can have funds there too. But generally speaking, this is for your stocks. This is for your Palo Alto networks and your CrowdStrikes and your Cloudflares and Metas and Amazon, so on and so forth. Tech will turn around, and when the market turns around, tech usually leads the way out. So depending on your time frame, depending on your risk profile, please take a look. Keep an eye on the markets. Don't get discouraged. It will turn around. So again, long term, buy and hold, keep pumping money through those 401ks, 403bs, your TSP if you work for the federal government. And if you are a trader, build cash, keep an eye out. And here are some of the metrics that I'm looking at that you don't have to spend a lot of time monitoring, but they are helpful in terms of kind of figuring out the near-term direction of the market. We're going to take a look at the VIX, the VIX. It's trading at $22.60 a share thereabouts today. And the VIX, for those of you who are new, is a volatility indicator. Now, when the markets are going up nicely, usually the VIX trades around $15 per share. So at 22.60 or thereabouts, it's a little high. So we see the markets receding. We see the markets pulling back or the increase in volatility. Another one is the 10-year Treasury, which is trading at about 4.2% on the 10-year yield. The markets were chugging along nicely last year and the year before at about 4.5%. So we're not that far off. And that tells me that people are not getting out of the stock market and moving into bonds per se,
What this says is that people are getting out of the market and going to cash. So the 10-year treasury as a metric shows that people are willing to wait this out, build cash on the sidelines, and then at some point, hopefully later this year, jump back in. Something else I like to watch is the dollar index, DXY, David X-ray yellow. When the markets are strong, the dollar index tends to move up as well. So it's been about as high as 109, 110 per share. Right now it's trading about 104. So as the markets recede, as the markets come down, that dollar index will soften. So between the VIX, the 10-year treasury, the dollar index, and last but definitely not least is gold prices. I'll tell you what, guys, gold spot prices are up 17.93% year to date, up almost 20% year to date. If you bought gold at the beginning of the year, you would have outperformed our stock markets, you would have outperformed European markets and Chinese markets as well. But it's hard to go ahead and wrap your mind around taking advantage of things like gold when we know that gold is a hedge against not just inflation, but stock market upside as well. So it does take a special type of investor to be able to switch gears and look at taking advantage of opportunities to the downside. But gold was definitely one of those areas. So as a metric we use to determine a bullish stance in the market, which most of us are bulls despite what we're seeing long term, we want to use these metrics to help us figure out the near term direction so we can prepare for our shorter term plays for you traders, you options traders, as well as you long term investors who are dollar cost averaging into your funds, whether they be through your employer or on your own. So, again, we're going to take a look at the VIX. We're going to take a look at the 10-year treasury, the dollar index, and of course, gold. And guys, I got to say this, please stick to your discipline. Don't go and try to create a new discipline just because it seems the market has turned a corner. More often than not, you are likely to be successful in the long haul if you've developed a discipline and you stick to it, meaning your risk profile based on your age, your amount of resources, and what you are trying to achieve in the market. Again, whether it be long term or shorter term for goals like buying a home, taking a vacation, just saving up in general. So I'd like to say, guys, that this was a great first quarter. It was not. I'd like to say that the beginning of the second quarter offers us some certainty. It does not. So exercise that discipline, watch the markets, continue to put money in those long term investments, and hopefully by the end of the second quarter, we will see a much better market. Hey, and if you guys have any questions, please reach out, touchstonefinancialeducation.com. Shoot us an email. We do answer questions pretty quickly. Thanks for listening. Keep the faith. Until next time.